Good morning, everyone. Welcome. Very excited today. Today is Tuesday, and we have a special guest together with us. We have, of course, Patrick. Welcome, Patrick.
And welcome, everyone.
And we have Jay. Jay, I think, is our second session. The last one, which was a few weeks ago, was amazing. It was on Forex, and we are very excited to have you here. Today, we're going to talk about, and we're going to share some live trading. We're going to look at market action on Forex. But maybe, Jay, for those who haven't met you before, if you want to maybe briefly introduce yourself, that would be awesome. And then we can start.
Good morning to you, Fabio. Good morning to you, Patrick. And good morning to all active traders and investors. It's a pleasure to be here once more. Thank you for inviting me. As you know, I'm a big fan of your additional adding value to our tool set that we have as active investors and traders. So thank you, Fabio, for your great product that you and your team are building and bringing out. And I don't get paid for this. I say this because I actually use it and enjoy it a lot. My name is Jay Medro. I've been working in the financial services industry for over 30 years. I come from the institutional side. I was a bond trader. I worked at large tier 1 houses like, for example, Lehman Brothers, Nomura, Societe Generale. So I had 7 or 8 very large houses, Talit Preban as an interdealer broker. I have a lot of experience, and I traded, as we say on the banking side, I traded a lot of books. And then I ran Germany, Austria, and Switzerland on the credit distribution side, which is a fancy name to say sales. So I was running a sales team, and my personal understanding of the markets increased significantly once I understood different types of clients. At one point in time, I then became the global head. Banks always restructure, and I became the global point of how do you say that? The global head of PIMCO. PIMCO is one of the largest asset managers. So for us at the bank, I was the one that coordinated globally all projects that we were doing with this very, very important client to us. And I would say at that point in time, my understanding of the markets and the interaction of markets and the needs of clients of the fund industry and the different types of clients opened up my eyes to something that allowed me to develop a process which I use on a daily basis since 2016 to understand the global flow of capital and to make educated trading and active investment decisions. So everything that I ever built and everything that I ever do is based on real life experience in the big leagues. It has really nothing to do with retail trading. And in 2016, I was shocked to find out that YouTube was filled in the German-speaking space about technical analysis, which is something that doesn't necessarily exist in the institutional world. A portfolio manager at PIMCO doesn't sit in front of charts, as an example. But your world, Fabio, and maybe you can allude to that again as well, you were working a lot with what we call fast money accounts, hedge funds, selling data. Yep. And the real world works based on data and on information. The real world is based on macroeconomic modeling. The game that you are in, if you know or don't know, the game doesn't care, is the different changes in economic growth and different developments of inflation. So that's the basic game, the economic game. Even if you trade equity, your sector, your company that you may be trading exists mainly in different geographies. An American company making a lot of their revenue, for example, in Europe, is dependent on the economic development in the US, but also the economic development of their clients who may be, in my example, in Europe. So the game is, how is Europe developing economically? How is the US developing economically? How is the sector developing within that economy that your company that you may be trading is part of? And how is the company developing in terms of their revenues, their expenses, and their net income and their cash flow? So the game is always the same. It's about math, data, and the change of the data. And once you understand that, and this is, where Mentor Q comes in, once you understand that all the markets are interconnected and who is the driver these days of capital, of flow into or out of the markets, and there's different players, then you have potentially an edge. And when you have an edge that you implement, then you have different tools that help you in generating your income, hopefully, in the bet that you're taking. And this is where your company, with your levels, Mentor Q, is coming in, like we alluded to last time, but I don't know if everybody saw the last video that we did. So right back at you, Fabio, what did you do before Mentor Q that allowed you to build what you built for us, the user?
Yeah, exactly. I mean, what you said is actually so true. And I think when I was working in the hedge fund industry, it was all about connection and correlation, right? So we are not living in a standalone country or a standalone company, or like everything is interconnected. So one tweet can move the market in China. One tweet can move the market in Japan. So it's very important as retail traders to understand how those connections could affect your portfolio, your trade, your asset. And basically what I was doing, I was selling data that could help those large hedge funds make that connection and build a strategy or an edge on top of that. Because always remember that all the strategies, they are only good until somebody doesn't exploit the alpha that is derived from there. So whenever you're trading, you need to build your edge, because that edge is not going to be there forever. So what we're trying to build here is allow you user to potentially connect information and then potentially develop an edge that you can do, and you can use it to become a profitable trader. Yeah.
So when we look at the levels, for example, and thank you for that, Fabio, the BL4, BL5, BL6 in dollar yen, which is an asset class. Dollar yen, if we look at it, is basically a picture. The price is a picture of the interest rates in the United States of America. And what is an interest rate? Is the price of money versus the interest rate of the Bank of Japan for the Japanese yen. So if you go on a daily chart in your example right now, I know disregarding the levels right now, if you go on a daily chart and if you go under all down in the x-axis to show all of the data, I want to explain something to you real quick. And if you press it together real hard, as far as the data would possibly go, you will see that something, that's the beginning. So it starts at 2009, this data. If you think about an FX, a currency, as a stock of a country, of an economy, then what does this actually mean to us, this picture? Well, it actually means that the United States of America, their economy, since the price is rising, is in the sense that the market is valuing this economy, it's worth more than the economy of Japan. Also, FX is following interest rates, especially the short-term interest rates, which is set by the central bank. So the interest rates right now is a lot higher in the United States, 4.25%, versus Japan, which is at 0.5%, right, at 0.5%. So if you look at a different pair, for example, if, for example, you take, that's just an example, Aussie versus yen. Here you see what we call the business cycle. So they're both in Asia, both economies, and they're not AI driven. Yeah. Australia is more a resource commodity driven economy, and Japan is an island that imports a lot of stuff, then adds value and exports a lot of stuff. So it's similar to what Germany used to be. It's an export economy, right? Here you can see a cycle curve, right? If Aussie versus yen on this macro chart is very high at what I call a top edge, like we recently were, it means, wow, the market perceives the Australian economy as a lot better than the Japanese economy. But then it cycles down again to a bottom edge where the market says, wow, the Australian economy is a lot worse than the Japanese economy. So before we start even talking about all kinds of levels and gamma, and let's go long, short here, you need to understand that what are you actually looking at? You know, a lot of people, for example, are trading gold, and they think gold is, I don't know what they think gold is, but based on the volatility of gold, gold is a currency, right? Whereas Bitcoin, a lot of people think Bitcoin is a currency. No, and I said this last time, Bitcoin is a commodity because to produce it, you need a lot of energy. And the volatility causes hedge funds like you used to work with, or banks and large buy-side clients like I work with. They base everything on the volatility of an asset class. So Patrick, you trade every day, and you asked me yesterday, Jay, what do you think about ATR as a stop loss? We're having lots of discussions within the team about ATRs and stop loss. And the correct answer from the institutional side is your stop loss depends on the volatility of the investment that you're actually involved in, right? So ATR is some sort of, it's a smarter way than just to say, okay, I'll take the last swing low, right? It's a smarter way. It goes in the right direction because it captures, at least historically, recently, what the volatility was. But a lot smarter way to go about it is to have an understanding of where a very important market segment expects volatility to be in this week, or for today, or in the next month, or in the next year. So who is the there's a picking order within the industry. There's a very smart market participants. Then there's the also very smart second row. And then there's like a long time nothing, and comes a completely different economic model of valuing their asset class. What am I talking about? The smartest people on a trading floor are the bond traders. It starts with the math already. It's quite complicated. The second smartest people are the option traders. And I'm alluding to implied volatility. The option market can tell you a lot of information about an asset, where the options market makers who work only with math and models and supply and demand of insurance, if you want to call an option an insurance contract, right? They only work with supply and demand. They give you, you can calculate based on implied volatility where Australian dollar versus Japanese yen, for example, is expected to go with 68% probability based on market pricing today, is expected to go today or this week or however long you want to derive the data. Now, the more liquid an asset is, the more people participate in the voting of, hey, what should be the fair price of this asset, right? If you and I, us three, if we have an auction right now about my watch, we only have 3 participants. It's similar like to the FX Asia session. There's not that many participants in the Asian session, so the fair value of the auction is less effective. If you go into the London session in FX, most of the participants are there. If you go during the 2 hours where London and New York intersect, you basically have almost everybody who's trading in that market participating in the auction process of what is the fair value of the watch, or in this case, what is the fairest value of Aussie yen. And all of this trading takes place. And like you said, Fabio, Trump is tweeting something. The Israelis, are sending rockets to Iran. All of this will overshadow, we call it sentiment, your trade, your edge. Sentiment can blow fundamental modeling out of the water temporarily. So what happens when rockets are flying? Implied volatility shoots up. We can look at oil, for example, and oil volatility, and you see it goes through the roof. Now, this means we have an opportunity as traders. So if you say, no, Jay, I followed online this YouTube guru, and he told me I have to become very, very good at euro dollar. Well, you can. But my question is, today, this morning, is euro dollar the best opportunity for you today? Or is the best opportunity that asset class where you have the most volatility and where you have the most action occurring because something either data-wise or something news-wise, we call that sentiment, is new information that changes the positioning of our former clients, Fabio, right? PIMCO will not touch their oil positioning until something new happens where they say, shit, I don't know if they say shit, sorry, shit, we are not long enough oil. With Iran maybe closing the Strait of Hormuz, we have to increase our oil long position, or we need to decrease our oil short position. If that happens, now you have very large players changing their positioning via execution algos, and we see that, and this can be our opportunity because we don't move the markets, the big boys move the markets. Yeah, I hope I didn't say too much, but I'm trying to say, sorry, go ahead, Fabio.
No, I mean, this was awesome. And I think it goes, like, we get a lot of questions from our users, like when there's a volatile day. I think when we had a 10% in the stock market a few months ago when Trump was tweeting like, oh, the levels are not working. What should I do now? And the thing is, like, models can only account for the information that we have as of today, right? But if something happens, like you mentioned, there's like rocket launch or there's like a tweet that happens, that is information that cannot be captured by any models. And I always give the example of COVID, right? Most of the macro funds kind of either went bust or lost a lot of money during COVID. And the reason is simple. They were not prepared for what happened. They were not like equipped with the data that could potentially forecast what would have happened if a pandemic was to hit at the level that it did. So I think, yeah, it's always important to be able to react to new information.
That is the reason why they react. Again, I said in the beginning, and I'm sorry that I say so much, somebody who's interested might have to rewatch this recording. Yeah. Everything is based on macroeconomic modeling. Even if the word turns you off, it doesn't change the reality. So big funds, doesn't matter if they're quant funds or if they have a different approach, they work based on a process. So my question to you is, if your process is you open up your chart in the morning, you slap euro dollar on there and you start going from level A to level B, that is not a process. What I do is similar to what the institutions are doing. We have a model that we run, and we have an idea what we want to trade this week based on the result of our model that we run on the weekends. And then we observe if data that's coming in, like economic data, we just had retail sales, we can look at that in a little bit, is it coming outside of what was expected? Or sentiment, is there another tweet? Trump left the G7 last night. People are speculating. Twitter was filled this morning. Sorry, I still say Twitter. Was filled this morning with the Chinese embassy is being evacuated in Tehran. Trump is telling people in Tehran to please evacuate the city. We have more refueling aircraft that you need in a hot war situation, deploying from US bases to European bases so they're closer to the flash zone, to Iran-Israel geography. So it looks very much like it's heating up, but, and can I show my screen real quick?
Yeah, absolutely.
But Jay, let me jump in before you go.
No, okay. I just wanted to say one real quick, one thing. So this is something that I look at every day. So based on the color, you see the 8 largest FX, just the FX, not the pairs, because we're not pair traders. We trade economies, And what I see right now, so this is the last 30 days, this is the last week, this is the last session, 8 hours, and this is the last hour. So the FX market is the largest market that you can look at, the most liquid market, okay? And what I'm seeing here is that right now, as we speak, Pat, money is flowing into the Aussie dollar, money is flowing into the New Zealand dollar, and money is flowing out of the Japanese yen and out of the Swiss franc. So this is what we call a risk-on scenario. Risk on means the market in its entirety is interested in adding risk assets. This is positive. Risk on doesn't mean, oh shit, you know, a lot of people misunderstand the terminology. They think risk on means it's risky. If something was risky, we would see the Japanese yen and the Swiss franc rise. We would see treasury bonds rise. So the next thing that I do, and then I'll let you jump in, I just wanted to show it real quick. What is the VIX doing in this moment in time, right? The VIX is the fear index. Oh, that's just a derogatory term for it. The VIX is derived on at-the-money options, 30 days out maturity on a rolling basis. And it tells us that in the next year, the S&P 500 cash index is expected to be 20.78% higher from the current level or 20.78% lower from the current level. Let me tell you something. 20.78 is a trading environment. It's not an investment environment. The industry, the financial services industry, is built for investing, not for trading. It doesn't exist. Somebody sitting at a bank who looks at charts and fires long or short doesn't exist. Even after the Volcker rule was dissolved, that's not how the industry works. That's something that retail people came up with, depicting this, oh yeah, I want to be a trader. There's no trading in a bank. There's market making. It's very different. But let me go back to this. So the VIX is a 20.8. So what happens in the industry is the volatility is high, and a lot of the real pension funds, the insurance companies, the regular funds, they're being told, hey, Fabio, today you have less capital that you're allowed to invest in. Why? Because 21% higher or lower is a lot more volatile than 12% or 10% or 9%. So then we go over, and the VIX is always leading. So the options market is leading the cash market, which is very important. Fabio, you can explain this later. You can explain it if you want. Do you see that bombs are flying and we have all kinds of negative, Tehran embassy is being evacuated? Do you see this fear in the equity market this morning, in the American equity market? No, you don't. We were at all-time highs, and we're at 60-50 in the ES front month. There is no fear. So why did I say this? Because the FX market is risk on, the equity market is risk on. So disregard all the noise and all the newsletters that are telling you this morning that the world is ending. Right now, as a trader, the world is not ending. Right now, I'm looking at opportunities where I could go into risk assets from the long side, disregarding all the noise. So there's a difference between what's really happening and what is the noise in the market. So back to you, Pat. Sorry. I said a lot.
Okay, yeah. That's a really good example. So I have so many questions, but I will ask the questions based on the community, because I think so much people have the question. So we was not really talking about this stop loss. So let's talk about, as a swing trader, position trader. When we talk about the stop loss, how you would be dealing with a stop loss, when you would be, say, if you go now, for example, long or short on gold or on euro or on some FX assets, when you would be placed your stop loss, and how much room you will give?
Mm-hmm. That's a very good question. So it always, in my instance, I always build into a position and I build out of a position. So I don't go, let's take one of your levels, for example. No, that's not it. Where is here? Maybe we can take gold, because I would trade gold from the long side right now. So the first thing you can do is you can add gold volatility to your chart, right?
Yep.
And you can give it a new own scale so you can have an understanding of what you're seeing. So it's not updating in real time, but I'm seeing roughly 20. So gold is expected to be up or down 20%, 19.87% within the next year from the current level. That's crazy, right? That's nuts.
That's really crazy.
That's absolutely nuts. 20% is okay. To give you an understanding, back to the industry, depending on which time frame you look in the past, and at Lehman we always said never trust the statistics that you didn't fake yourself, right? Depending on how far we look back in history, the S&P 500, if you just invest in the US stock index, S&P 500 generates about 8.5% return. That is amazing. Why is it amazing? Because if I currently invest in the so-called risk-free rate, the market is based mathematically on the risk-free rate. What is risk-free in the sense of the market? I'm lending the US government money. So if I lend the US government money, the federal funds rate is at 4.25 right now. Meaning I lend the US money for 1 year, I get roughly 4.25% or $42,500. Up until Trump, this was tax-free in the sense there's no, in German we say Quellensteuer. There's no withholding tax on it, right? The US has so much debt, so they needed to incentivize foreigners to purchase their debt. So there's no withholding tax if you invest in US government bonds. So I invest $1 million, I get $42,500. A lot of your viewers right now could live off of $42,500 income, especially if you're in a tax-free area like Cayman Islands, Bahamas, Dubai. You know, that's another thing we can talk about one day. Your trading account needs to be, in my personal opinion, in a region where it can grow without taxes. Your trading investment account, because otherwise you keep fighting the government stealing your money. But that's a whole different thing. You know, it's very important. Like everybody who's very, very, very smart has money in an offshore tax location and trades in that location. It's, by the way, not that difficult. We do this in our company a lot. We give people the connection of people who can help them with that. If you have no money, not important. But if you have a little bit of money, very important. Okay, so your levels, and you can talk about your levels now, and you tell me which one you want me to put on or you want me to put off. What a regular retail trader potentially, I don't know, I'm making this up, you know, would say, okay, I want to be long. You can't show any charts. You said that, right? So if you wanted to be long today, what is, for example, a very good spot to be long? Let's incorporate your levels, right? To be long. And then I tell you if I would concur or not. Based on your levels, tell me the best trade. We're not saying it's going to happen. What would be the ideal trade, in your opinion, as a trade today, based on your levels? From where to where would you go?
Oh, so I tell everyone my A+ setup is always trading from the high vol 0 DTE. So you see this also, high vol or high vol 0 DTE, and then target the one-day min if you be battling on the upside, or targeting the one-day max. So that would be my entry, depend on the market action.
Okay, so let's put this in. You're saying, hypothetically, from the high vol 0 DTE level, yeah, and ideal would be min. I don't see the min level.
Oh, the max, sorry. If you target the one-day max for the upside, yeah.
Okay, perfect. I love it. So, and now we can talk a little bit about Gamma. So, if this was a trade that institutions were to be looking at as well, institutions have to move a lot of money. A lot of money. They're not trading 0.01 lots like you and I do. And I'm joking because I know you trade larger, but you know, we don't move the market. So gold is a very thin market. So know your market. If this was treasury bonds, very thick, very different behavior. Very different behavior about the levels, by the way, too. Like if you look at your levels at a treasury market, they will work very differently from oil, gold, or ES, for example. Right now, we are in what's called a positive gamma environment in the equity market. So how can we explain in 2 sentences what gamma is? Or let me put it this way. The derivatives market, the option market, is so big these days, is so big and so important and keeps growing, that the hedging behavior of the options market maker will actually have an influence on your trading, on the cash market. And I think we're showing my screen. So let me teach you something, since I love teaching. When we learn about options, and all of us, whoever worked at a bank, in the trading function, I was a bond trader, I need to be a Eurex certified derivatives trader. So I actually had to go physically to Eurex in Frankfurt back then and take their examination. So there's a lot to learn, and we are all certified derivatives traders, all of us. Why? Because the options and the futures are hedging products for us. Hedging is just a fancy English term for I'm offsetting risk. If a client sells bonds to me, let's say a corporate bond, BMW, and a bond that has 5 more years to run until it matures. My job as a market maker is to provide liquidity to the market. So I'm buying 5 million bonds. So let's think about what type of risks I have when I own 5 million BMW bonds, okay? Pat, what could happen that changes the price of this bond? What do you know? What could happen?
So basically, I'm not a bond trader, so to be really fair. So
BMW could go bankrupt, right? They could go bankrupt. Then I don't get my money back, right? They could go bankrupt. The insurance product that we can buy for that, it's called CDS, Credit Default Swap, right? There's a huge market. When I started in the industry, CDS just started in the beginning. So CDS, the interest rate can change in the market. So based on bond mathematics, and we're not doing this here today, you know, when interest rates go up, bond prices go down. So that's something that could happen. And I could maybe have it in a different currency and not euro. Then I would have Forex exchange rate risk on the book. We always call risk being on the book. So if I want to hedge something, in this case, the interest rate risk, right? I don't think BMW is going to go bankrupt. As a market maker, I'm allowed to have that position up to 3 months on my book. Then I need to sell it based on law. I'm not an investor. I'm a market maker, right? I need to get rid of this position. So, but the interest rates change all the time in the market based on supply and demand, based on rockets flying, and based on Jay Powell says something, right? Like this week we have FOMC, very important, by the way. So if I am in a situation where I am long an asset, this is what happens when I'm long an asset. What do you see on the x-axis? Somewhere I can write, right? Can I write on your?
I think you can use the text.
The magic pen. Is it called magic pen, or what was the name of the magic pen? What is the epic pen? All right, let me do it this way. It's easier. Real quick. I hope we have time. It's going to be value adding for you watching this. It's going to be value adding because you'll understand how awesome the gamma levels are, how important they are, and why I'm such a big fan of Fabio and the company offering it. All right, so I got a pen, and here's what I'm doing. Here on this axis, we have what's called P&L, profit and loss. And here we have in financial mathematics S, which is just the price of the asset.
I think, so Jay, 1 second, are you sharing something else? Because we can only see your trading view screen.
Oh, no. Why can you not see? Yeah, I'm sharing a Paint.
Okay, maybe what you want to do is you want to go on present and reshare your screen again.
Okay, let's do that because super.
Yeah, and click stop sharing and yeah, exactly.
Stop sharing and present again. Let's try that. Thank you so much for letting me know.
Yeah, and guys, also if you have questions, please send us.
Fire away.
Yeah.
Fire away.
We're here for you guys. So
cool. Okay, so it's happening. All right, super. I think you can see it now. All right. So what I was writing, and I hope it shows, is up here is P and L. Can you see P and L? Because I can't see that. You can see what I'm writing on here.
No, we cannot see. We can only see the lines.
Okay, that sucks. That sucks. But it is what it is. I will.
You use the pen from Paint.
Where's the Paint pen? Here.
At the top. Yeah.
Ah, perfect. Thank you, mate. Awesome. All right, cool. So if I buy a stock, NVIDIA, this is NVIDIA stock, right? And I buy it at 100, and that's what I paid. You know, my P&L is 0, so the 100 should be here. So this is 100, right? I didn't make any money. It goes to 110. So the way that you read the chart is I just made plus $10. Okay, very simple chart. Does everybody understand that?
Yeah.
We call these hockey sticks. This is what you have to do when you get into trading options. All right. So what happens next is P&L can stay, and this can stay as well. I need to get rid of the this line. So you're not long NVIDIA right now. You're an options market maker, and I'm in the process of explaining to you why the levels are so awesome and why it's very important to understand where the option market has levels in the asset class, whatever that may be that you're trading. If a client sells a call, or he buys the call, NVIDIA call, okay? The client is long the call. So hypothetically, what that means for the client, I'm drawing the client has to spend some money, minus. Let's say he buys a 30-day call for 110 for $5. Okay, so the client spends $5 for NVIDIA to go to 110 and higher, because higher at 115, that's his or her break-even point. At 115, the client has made no money. Who earned the $5 so far? Who earned the $5 so far? The options market maker. The options market maker sold the client the right to purchase 100 NVIDIA shares within, let's say, 30 days, and that cost the client $5. $5 times 100 shares, so it's 500 per contract. Are you still with me, or is that too complicated? I hope you're still with me.
Yeah, I'm good.
If NVIDIA keeps rising and rising and rising, the client makes more and more and more and more money. So what happened during GameStop, and there's a great movie on it that I forgot what the movie's name is. You have to watch it. Yeah. This was during pandemic when we were all locked up, right? Some ex-options market maker explained to 1.1 million Reddit users how we can screw, I was going to say the F word, sorry, how we can screw the options market maker. Because the options market maker has the opposite position. Do you want me to show you what the options market maker looks like? Because the minute that the client has NVIDIA going above 115, the options market maker is losing money, right? Because he only earns $5. So the options market maker first makes $5. This is his plus $5 up to 115. At 115 and lower, the options market maker is starting to lose money. The client makes money, the options market maker loses money. Do you think we are in the business of losing money? No. So what do we do the moment that the NVIDIA stock goes above 115? The market maker has this position. This is the position that the market maker has. He wants to protect. And it's not him doing it physically himself. It's actually the algorithm doing it. The market maker will go ahead Can I make the pen thicker? Do you know if that's possible somewhere? If I can make it thicker? Doesn't matter. So in order to offset this hockey stick going down, the market maker will just go ahead at 115 and buy the stock. Delta hedged. Delta hedged. Delta means you buy any option and it has a delta of 0.5. We say it's at the money. Basically, in that moment in time, Patrick, because Fabio knows this, you probably as well, but I'm just pretending I'm teaching you. At that moment in time, this option has a 50% probability to end up in the money at the time when it expires. If we now have the situation that NVIDIA is rising and rising and rising, this call option will rise along with NVIDIA. Why? Because it's a contract that gives you the right to buy NVIDIA at the price, the strike price that you purchased. If the stock increases, the option becomes more and more worth. Yeah, it rises in value. So the delta starts rising. It's not 0.5 anymore. It's 0.6, 0.7, 0.8, 0.9. So here's an important lesson. At one point in time, this option that the market maker sold will have a delta of 1, and the market maker will have exactly 100 shares long. And this position is hedged, fully hedged, fully hedged. Now you're looking at gamma levels in your chart, and we'll go back to the chart right now. And the question is this gamma level negative gamma or positive gamma? And this discussion that I had with Fabio is quite tricky, and it's too much for today's webinar. But what can happen is two things can happen. Either the market makers, they're very, very, very much short options here, lots of short options. Then you have a situation where the market turns before that level. In your trading, have you ever seen that, Pat? That you have a very important level. Wow, something just happened, and I heard. So one of us changed their mic. Because I hear myself. Did you change something, Pat, or you, Fabio? Okay, it's gone. Super. Thank you very much for changing it back. Perfect. Or it gets slippy, and that means what I tried to explain to you, maybe I didn't do a good job, who knows? What I tried to explain to you is in that moment in time where it crosses such a barrier, where there's a lot of options outstanding, the hedging activity of the options market makers, them buying the underlying, may it be euro dollar, may it be gold, may it be oil, doesn't matter. It's like a turbo. It flies through the level. So if that's the case, the level was very short gamma from the point of the options market maker, and we call it a slippy level, or it's slippy and then it turns before the level. Knowing this, Pat, I'm watching like a hawk as whatever I'm trading, let's say gold, is approaching your level in the chart. I'm watching it because I'm watching either this will happen or this will happen. And it's very easy. And you said this yourself. You said mentor Q levels are tools that you put on top of your edge. So I love the levels because they give the trader structure for today. There's a great structure. What's the best structure? You go, just like you're saying, you go to the high volume node, yeah, to the either day max, but depending on the environment, the context, you may or may not reach today's day max. Yeah, that is headlines, Trump tweets, economic numbers, what I tried to explain earlier. Or the environment gives you enough firepower, enough reason that portfolio managers come to work and say, shit, I'm not long enough oil. And then you want to target these levels. And you want to maybe even go beyond the levels. So how do you know that? You need to know your markets, and you need to know the news headlines, and you need to know the data. If you don't know the economic calendar, you come to a game where professionals who do this shit for 30 years, day and night, never sleep, work all the time, have the best education in the world, and you think it's enough to open up a chart in your MT5 and to trade from one level to the other. That's not good enough. If that was enough, you, my friend, would be working at Goldman Sachs and making them billions. They would give you all the capital in the world. It's not that easy. But it can be easier if you wait for very good opportunities that you understand. And that's possible. It's absolutely possible. Fabio, you have a question. I see your mouth. You wanted to say.
If I can add to that, Jay. So I think it's important to understand the trend that we are living in today. So first of all, I think something around 80 or 90% of the execution in the option market is done by market makers. That means that there is somebody on the other side that is taking a risk, and market makers are not, like you said, in the business of taking risks. So that means that most of the option trade that we see are basically not executed by other customers. Like when you sell shares, you buy my shares, I sell your shares. There's an exchange of 100 shares of Apple that goes from one account to the other one. In the option market, most of the time, the shares are not executed. The contracts are not executed. Second thing, we are at the highest level we've ever been in history on option volume. So again, we have a lot of option activity, and therefore there's a lot of hedging. And then, of course, we have the macroeconomic context. So I think understanding all these pieces of the puzzle together can really help you understand when the level will have an inflection point to the upside or the downside, or when it become a strong support or resistance.
Absolutely, absolutely. And again, that can be your edge. So we're looking at today's level, and looking at this, for example, just think logically about what you're seeing, just logically. I'm seeing a very large bar, a red bar in a 1 hour chart. And I see a lot of volume compared to everything that happened prior. What happened here is what I call institutional selling. Ex-colleagues, ex-clients of mine, there's some real institutional selling going on here at this level, 3, 4, 15. So going back to your trade idea right now, Pat, I'm going to make it better based on what I'm saying and what I'm seeing. Based on the fact that here we have the beginning, so to speak, of an institutional move that then compressed a little bit lower, I am automatically updating my trade. I'm updating my trade, and I'm lowering the target to here. Why? If we're going higher, this was the last time an institutional sell activity can be observed in a candlestick chart with volume. That's the last time I saw it. So this is the first time I see potential stress if this institutional seller is still there. And I don't mean him or her specifically. It's not like, oh, Jay Medro was selling there. No, that's not what I mean. But the market aggregated had an interest of selling it here. Now, why is this interesting? Because earlier on, we saw an institutional buying interest at this level. Do you see this type of bar, volume bar? There's a lot of institutional interest there. Otherwise, we would not see volume. Now, what was the reaction of price? Price rose afterwards. Now, let me tell you what I did as a bond trader. So I'm sitting there. Unfortunately, I don't have an old phone, so I'm going to use this, right? And my phone rings, and it's my sales guy, Fabio, and Fabio covers the Central Bank of China. Yes, actually, us, Tier 1 investment banks, speak to other central banks. We speak to every hedge fund, every central bank, governments, there's parties involved in the institutional market. The whole world is trading and investing. So I'm here at this moment in time, and I'm getting a call from Fabio, and Fabio tells me, Jay, I got the Chinese People's Bank of China on the phone, and they want to buy gold. Now, how does that make me feel as a market maker in gold when one of the largest central banks in the world is calling me and they want to buy gold? Do I feel good about this, or do I feel bad about this as a market maker? Because logically, what do you think is going to happen next, Patrick? Think about it.
So first things, I would look first in okay, why is this happening? So always ask the question first, why? Why is someone getting stressed? So check the news, check what is going on in the market, and then I will find the answer, and then I will follow the big money, of course. I will not battling against them.
Exactly. And as a market maker, I have to sell to them. I have to sell, right?
Yep.
Let's say I have 100 contracts of gold. I'm making this up. And they want to buy 1,000. So I have a problem, right? I can't give them my 100. If I give them the 1,000, I'm short 900. And now think logically. If the People's Bank of China buys gold, and exactly like you're saying, why the fuck are they doing that? You know, who's going to buy next? Well, I tell you, the European Central Bank is going to buy gold, and the Bank of Japan is going to buy gold, and the Federal Reserve is going to buy gold. Everybody's going to buy gold. And this is exactly what's happening when you see large institutional interest with candlesticks going ballistic afterwards. One of the things that I can teach you from my decades of playing in the first league is the buy side. They all do the same, but they do it. The smartest are doing it first. Then the second smartest are hearing about it, and then they implement it. And by the time it's on the Bild newspaper, which is a tabloid in Germany, and it says buy gold, the trade is over. You know, I'm exaggerating, but retail hears about the trade levels. Yeah, I hear myself again. So, all right. So why do I like this level? This level I like because I saw institutional buying there last time. Now what's happening? I saw institutional selling here. So if I get a buy signal, maybe on a lower time frame, and if I see the dollar falling, but I see oil rising, as an example, I have two factors that go into a macroeconomic model that will flash to my ex-colleagues saying, you are not long enough oil. Did you hear what I just said? Two factors. One is the US dollar. Why is the US dollar important? Because gold is paid for in dollars. So let's look at the dollar. I don't know if it's showing it again or not. No, it doesn't. So I need to stop again. Wait, I need to stop. And then I need to start again. This is a little annoying that you always have to do this, but it's important that you see the next picture. Okay. Here it is. Wait. Is it coming? Can you see it? Yeah. All right. Right now, I'm seeing the dollar getting stronger. So let's say you're getting a buy signal based on technical analysis in your chart and you want to buy gold. But if the dollar gets stronger, is that good or is that bad for gold? The answer is it's bad for gold. Why? Because a European investor needs to exchange euros into dollars. The dollar is just getting more expensive. Then he or she needs to take these dollars and buy a gold contract in dollar. Do you understand? So for everybody else in the whole world, when the dollar rises, gold becomes more expensive for them. If the dollar were falling right now and you get a buy signal for your gold chart, that would be positive for your potential long. Okay? Because you told me, hey, Jay, people need an edge, Dude, if you don't have an edge, don't even trade, right? So now let's look at the treasury market. Okay, now I need to stop again. In the future, we're going to use a different, hopefully different platform because I switch shit around a lot, Fabio. If I always have to go stop, select new. Okay, anyway, so wait, it's going to come. Oh, funny. Okay, you can see it now. It's working. All right. So now let's look at oil. Okay, good. Oil is rising right now, right? It's going from the bottom left to the top right. So oil rising means inflation is rising. there's a very high correlation between oil, which everybody needs, and all the products we derive from oil, and inflation. So inflation rising is positive for gold. So looking at two different input variables right now, the dollar is rising negative for gold. Oil is rising good for gold in the sense that inflation is rising. You look at the bonds are falling right now. That means the yield is rising. Why? Because inflation is rising. Again, I can teach you for 800 days. People who come into my company, they learn a lot. They learn a lot. But let's take these two examples in very important input variables. Gold reacts to the real yield. We just looked at inflation, which is a very component of real yield, and gold reacts to the dollar. So if we see that one is positive and one is negative, it can explain to you why there is no direction in gold right now. Do you understand that it's a two time frame? We call it two time frame market. It's going sideways. So you could scalp it. So you just took your, hey, this is my long trade. This is my playbook. I played football in high school, right? And you get a playbook. And I was like, oh, there's no trend today, right now. So you get rid of this play and you get the other playbook. And the other play is I'm scalping. I'm going from top to bottom and from bottom to top. Okay? So you need to understand what's driving your market, what character your market has in this moment in time, and then accordingly trade. Now I'm using your levels differently, right? Now I would potentially go ahead and say, all right, it's a very tight market. Everybody's waiting for the next headline. I'm looking for, on maybe a 5-minute chart or lower, I'm looking for a long. If we go into what I call liquidity down here, because institutionals need liquidity, and then when I go back up above the high vol 0 DTE, I'm going to go to GEX2. Okay, so now I have my range. Now I say I take 1% of my account. This has a high probability. And then now I can decide my stop loss based on the structure of the market and how much profit I expect to make. And I adapt to according to the volatility. Is there more data coming today? No, there is not. Is anything happening right now with risk on, risk off? I'm looking and I'm seeing, yes, it's a little risk offish. And that means if we hit into this liquidity here, super, I'm looking for a long signal. And then I would say, I'm willing to risk 1%. I want to make, let's say, 1.5%. So I am calculating what is the distance between high vol 0 DTE all the way to GEX2. That's my distance. I calculate that into 1% of my account, or you know how many dollars 1% of my account is. And this is 1.5, the distance. So I divide that, the distance divided by 1.5, and then I have my stop loss. So I'm risking 1% to make 1.5%. I hope that made sense. Otherwise, we'll go through the calculations next time if we see each other again. But there was a lot in here, and I didn't prepare any slides. Usually, you know, I have a lot of slides and blah, blah, blah. Now I need to take into account, and I taught this to my guys yesterday. We had a 4.5-hour session yesterday with my traders, 108 traders, 4.5 hours where I went into all kinds of different topics based on their questions. Time of day. What time is it? It's 10:30 right now. It's very good because the algorithms update every half hour and every hour. It's crazy, but they do, right? Economic numbers comes at 8:30 or at 2 p.m., right? Us humans, for whatever reason, we still look on the hour and on the half hour. So when I started trading, I was forbidden to go to the toilet when there was economic numbers. I had to be on the desk. And when there's a full hour or half hour, because new orders are hitting the market at that moment in time. And today, like Fabio said, JP Morgan estimates that 90% of all equity flows in the stock market in the United States of America are all rules-based and algorithmic trading. If you don't know the gamma level, I don't know what you're doing. I really don't. You need to know these levels, and then you need to put it in the context. So if you don't have a news feed, what are you doing? Will you, I pay thousands of dollars per year for news and analysis from top providers. I have 2 different news feeds up and running, and in real time, they tell me if something happens. You will know it too, because when you're trading gold and something happens, the gold market will go through the roof, and 30 seconds later, one of the speakers will come up and say, holy shit, the Chinese embassy in Tehran just got accidentally hit by one of the rockets from the Israelis. That would be immediate risk off. Oil would go through the roof because everybody would think World War III has just broken out. So oil is going to go to 120 and gold will rush through. Look how awesome this is. We're going right. This trade is starting to happen. I love it. As we speak, this trade is, look, you have sellers. Why is there more volume right now? Because there's liquidity. If you have something like Bookmap, you can see it. Right now, there's liquidity happening as we speak. If we go into the 30-second chart, yeah, they're running stops, whoever they are, the market. I'm not saying there's anybody there. Oh, there's Patrick P and his stop, and we're going to get his stop. That's not how it works. But they're generating entry liquidity. Sorry, Fabio.
Another misconception that a lot of retail traders have, that market makers are here to take our money, right? That's a misconception. They're just executing based on market structure. So correct. Yes, they are on the other side and they are against the retail traders, but they're not there to take the money. They're just executing to stay delta hedge and stay protected, right?
And look at what you're seeing right now. This is awesome, really. You see, look, the way I look at a chart, and I'm giving a lot away from stuff that I teach people, and I teach a lot. This is how I look at any chart. So if you have some guru who shows you a chart without volume, I don't know what the fuck you're looking at. Sorry for my French. I don't. Because I don't see institutional interest and I don't see the absence of institutional interest. Both is ultra important to see, right? So I'm seeing buyers here, and buyers here, and I'm seeing more sellers. So if I look at the chart right now, the buyer here, yes, there was some buying. Were they effective? No, selling came in, okay? The buyer here, were they effective? No, it's even a doji. They weren't effective at all. So every time I'm seeing, here's more buyers. Were they effective? No. So there's no way in hell that I'm going to buy this market right now. I'm not. I need to wait until the sellers are done, until the buyers are showing up, until the reaction of price is bullish. And that's why I have all the time in the world that I can wait for the market to find its bottom and to turn around. And I trade what I see. This was my idea to go long. We already said it's a 2-time frame market, right? I'm seeing the dollar is rising and rising. This is really shitty for gold, really bad. And what are the bonds doing? What is oil doing? Oil is right. This is actually good for gold. So I'm waiting. I'm waiting until the dollar strength is done. I'm waiting until I see buyers. I'm waiting until the sellers are done. And then, it's 9:37, 10:37 right now. Look, this is interesting too, because this is bullshit. You see a lot of distance with not much in the beginning, not much selling interest. Now, or institutional interest. Now there's a lot of institutional interest coming in. Why? Because it's a gamma level. So what I showed you earlier, and now imagine I'm pulling in what I drew earlier on, the picture with the hockey sticks. I can't do it because, it's going to take too long. But this is happening right now. There's put options. Put options, the opposite picture of what we saw earlier on. And these put options by the market makers are increasing in delta. That means at one point in time, the market maker is now losing on puts that he or she sold to clients. And the hedging is they are shorting the gold futures into their short put options to offset their risk. To So you need to know all of this shit. So put support is actually a cool name because maybe it is support, maybe it's slippy. We don't know that. All we know is that there's a lot of exposure down there on the put side. And if they defend the level, the gold market will turn around before the level. This is one of the major teachings I can give you today. Yeah. You wait. This was a lot of selling interest. Here's decent buyers. They're not effective. You have a little bit fewer sellers right now. The candle is not as long, so there's some sort of absorption there. You know, I used to spend so much money on software, and I had every tool on earth. Do I really need Bookmap? Maybe I do, maybe I don't, right? And I'm not trying to go against Bookmap. I'm just saying sometimes all it needs is a fucking brain and think about what you're actually seeing and tell yourself that. I am seeing a lot of sellers and they are effective. I'm seeing a decent amount of buyers. They are not effective. Don't fucking buy. You do not buy right now. You don't. You are the only one. And you're doing what we call catching a falling knife. Have you heard of that? Catching a falling knife? Don't catch a falling knife. So, yeah, but I miss these guys. No, wait. Because what they're doing is this hedging behavior of the algorithms. They will check if the sellers are still there. So you will see at one point in time, if this is turning around, you will see a red candle with no volume. And that is what we call a low volume test. They're testing if sellers are still there, institutional sellers, not you and I. If they're not there, then it's safer to go back to your original trade idea and look for the long. And there's a specific buy and sell signal that I teach to my traders that obviously because they paid money, I'm not going to teach right now for free. But this is, it doesn't matter if you're intraday on a 30-second chart or if you're on a daily and you're looking at McDonald's, which I am currently looking at if I want to buy McDonald's down here, an alarm fired early on. It's always the same. Do you see how now you have buyers in the market? How different that is, right? And we turned around at a level where some hedging activity is because it was a gamma level. GEX1 is a gamma level. And so now these guys who shorted the stock or the gold futures, the same algorithms, because the delta is changing, are buying back the stock right now. And that creates a V. And a V has absolutely nothing to do with an investor buying. This is option market maker hedging activity. They're hedging. There's no more threat. The sellers are not there. So the algo unwinds the hedge. That's all that's happening. So this is like down, up. Did you see any sellers yet? No. So could it be that I'm missing the long? Yes. But at a later point in time, the original trade will come in and it can work then.
Because and Jay, if you want to add the blind spots,
sorry, yeah, Fabio, no, sorry. Yeah,
if you want to add the blind spots level on the chart, it's also another good example.
When you do what? Tell me again.
If you want to add the blind spots to that chart,
perfect.
You will see that basically we also have kind of like a blind spot level there as well.
Awesome. I love it. Thank you for that. Yeah. This is the zone that Patrick creates, right? You create zones with blind spot and gamma, Patrick?
Yes, that's correct. So that's basically, I see this as a magnet. So I'm not a market maker like you, but I highly believe that if we see some blind spot with supporting some gamma level, this has some reason. So why we see this? Because there's a strong magnet and the market goes to the strong magnet, goes there, take it, and then we will touch this, and that's the opportunity. So basically, I'm looking always where blind spots supporting gamma levels, and that's my magnet area.
Perfect. Okay, cool. To me, it's still not the best trade right now because the dollar is getting stronger and stronger and stronger. So that's another thing. A lot of retail traders have fear of missing out. You know, they get nervous. Shit, I missed the trade, and this was, and they get nervous. This is quality-wise not the best trade. It's not the best trade yet. If the dollar comes off and I see that sellers are exhausted, the original trade idea that you had earlier on, Patrick, is on. And that trade idea is trading from, that we showed earlier on, trading from the 0 DTE level to the liquidity that we're seeing here. I would take it even further down now, right? Because there's liquidity here, and this is where the institutional selling started. So I'm adjusting the level a little bit, and I'm saying this is the trade. I'm going to send you a picture if that trade happens, because we went over an hour already. I don't know if that's good or bad, but if you put a volume profile on here, from here to here, and I don't have to be exact, between the value area low and the value area high, there was a lot of volume. The function of the market is to find the fair value of a market, and that's called price discovery. In this area, there's no price discovery needed anymore. The market already discovered all the prices that it wanted to discover, right? So there's a very high likelihood that I can trade from the value area low through the POC to the value area high. So I like this trade more and more. And me personally, the trade that I'm going to take today then at a later point is this, is this trade. This is what I'm going to, so you ask me, you know, can I use your tools and put another edge on there? And I say, yeah, this is what I do a lot. We call this the inside day trade, right? I'm taking it once we, if we go back here, I see the dollar coming off, oil is still high. This is the trade I'm taking. And then I took a high quality trade that is according to the sentiment. There's no more data today. And now I'm putting a technical correct market structure on top of the trade with the correct playbook, and then I make my money. But it takes a lot of experience, a lot of knowledge, and you have to be cool as ice. Don't get excited. This is just business. There's nothing to get excited about trading. Nada, nil. It's a lot about observing, understanding what's happening, and waiting for the best opportunities. So it's,
and we missed one point. I think it's also be patient. So as we was see, Jay, so as it was confirmed, so the trade idea looks good, but we are be patient. We are not stupid that adding directly our trades to go long. We want to see first how everything plays out, and then we will come in. So we be patient. We have a trade idea in our mind, what we will be execute, but we will be patient. We will wait until we're getting the right time to enter the market, and not directly. If it maybe it doesn't mean if it hits high vol 0 DTE or it hits some level, this doesn't mean that you have immediately go into the market. Be patient, wait, and then you can execute. Never execute directly. Only if there's a really big news coming out. That's a different approach. But for now, where we stay here, it makes no sense to go directly into the market. Wait until we retest this, we come back and let it play out, and then boom, you can go.
100% correct. 100% correct. And I'm watching the dollar. The dollar is still too strong. The trade, the quality of the trade is not there yet. I go back to what I tried to say earlier on today. The real world, the financial services industry is based on macroeconomic models. So they take different data points, and gold reacts to real yield and the US dollar. So we have real yield that is coming down. That's good for gold in the form of oil rising, which is a placeholder for inflation rising. That's good for gold, but the dollar is too strong. Once I see the dollar get weaker, I'm ready to go. Now, which currency do you know could benefit from a rising oil prices? From rising oil prices, Patrick? Which currency?
The Canadian dollar. The Canadian dollar. So
look at the Canadian dollar, and what is the problem right now? The Canadian dollar is rising, but the dollar is rising. So is US dollar, Canadian dollar, is that maybe the best currency pair that you can look at right now, just because you have gamma levels for it? No, it's not, because it's going to go sideways. Let me prove it to you. Where's dollar CAD? Here. Both are strong. So you don't have the best opportunity in a market where both are going in the same direction, meaning both currencies are strong. But the Canadian dollar is strong right now, and the New Zealand dollar is weak. So if we would say, okay, and I'm going to switch it back, New Zealand dollar CAD, Canadian dollar is strong, New Zealand dollar is weak right now. I can see this. We would expect it to go down. Very interesting right now. We are on a 1 hour chart. So we just went into liquidity, yeah? And we did an inside day play that I just showed to you. So if you go on a 5-minute chart, I know we don't have levels for it, but what we can see is exactly one of my trades that I would do. I'm seeing sellers, 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 a few buyers. We're going into liquidity. Remember, this is from an hourly chart. We're testing into it. Yeah, we're not effective. And then we see sellers coming in. You see more sellers coming in. And we're going from value area high through the POC to value area low into the opposite liquidity on the other side. There was, as we were talking about gold, there was a very easy, logical trade based on oil is rising, Canadian dollar I would look to go long. Takes me 1 minute to look at my strength versus weakness indicator, and I see New Zealand dollar is the weakest currency right now. So I look at this, I get my sell signal, and I take the play from my playbook called Inside Day, and I just made the money. Right? So nothing has to be complicated. You just have to, in my opinion, you have to learn a lot in the beginning of your career. Take your time observing these things. And that's why I think intraday is a horrible place to learn this business. And it's also a horrible place to think you have to rush your education and you have to rush your career as a trader or active investor. That's like, you know, hey, you want to become a brain surgeon? Okay, get a PDF and start doing surgery on open brains. That's a horrible idea, okay? It's your money. It's hard enough to get money. You don't want to lose money in the markets because you're the guy who we eat for lunch. We meaning the professionals, right? Don't be the sheep that we slaughter and we drink your blood and eat your food, eat your meat, you know? We call it donation. Don't donate your money to us. Learn the business, understand what is driving what are the drivers of my market, and then use excellent tools like you have in the form of, for example, the GEX levels and the blind spot levels that we saw earlier on in the gold market. And now I'm telling you, I'm going to laugh my ass off. I spend all this time with you. I'm going to take this trade today. You know, I'm going to take it. It's only 11 o'clock. 9 minutes to 11 o'clock.
Jay, let me add something to this, because you was making a really good point. And you know what is the first question from a beginner trader when he shows up in a live trading room or he shows up on MentorQ? How long it takes until I be profitable? How long I can, is it possible that I make consistently profitables in 1 year? So then I give them always a little tiny background and say, hey, you know, we playing with institutionals, we playing with really big players. So what do you think, how long they take until they getting a huge edge and what they have on the background? So they have on the background the best tools ever in the market. They have all the news feeds, what you never have. They have all the education. Now it comes to a really good point. Before you can start on a desk, you have to have first the great and biggest education available. So they will teach you all the lessons before you're doing something. And this is all the part what you're missing, and they're doing this full time. They spending months over months over months before they taking his first trade. And now you came as a retail trader and telling us without all the education, without all the tools what's available on institutionals, that you can become, as a part-time trader, who takes maybe 1 hour each day, that you can become in 1 year consistently profitable, there's no way. That's no way. So that's the donation, what we're talking about. And this is why I'm so happy, Jay, that you're here, because you teach us in, let's say 90 minutes, it is now 80 minutes, really good stuff, but it's only a little tiny cookie. It's not the big one. It's only a little tiny cookie. But if you want to get the full big picture, I highly recommend to everyone, reach out to Jay, because what he is teaching now to you, that's so amazing. And Jay, I have only one little tiny questions. I know we have so many questions from the people, but the people should send you a message. You should be go in contact with the people if they have a really question, but only one little question for everyone, because this is so important to understand. And you was talking about this in the beginning, and I think so many people don't get the point. Where you see when we have a risk-on event, where you see when we have a risk-off event, especially for indies traders who are trading ES or NQ, because that's so important to understand. Risk on, risk off, how you can measure this.
Yeah, perfect. Thank you for the very intelligent question. So the FX market being the most liquid market is my first view. That's why I had years ago programmed one guy for MT4. Based on my input variables, he programmed me my strength versus weakness indicator, right? And it's in real time, and it's actually calculating mathematically correct in which currency money is flowing into and out of which currency money is flowing out to. So there's no moving averages. There's none of this nonsense, right? What do I need a moving average for? I can look at price and volume and volatility in real time. I don't need an indicator to show me this. I can do it. So I taught you today, or I showed you today, that in a chart, the first thing I look at is the volume. I don't even see the bars, because price is marketing. Price is just marketing. It's like, if you only look at price, that's why price action courses are ridiculous to me. High prices are supposed to attract institutional sellers. And this is what happens in the economy. If oil goes super high, it's going to be very opportune at very high prices to start looking for new oil reserves and investing in new oil platforms again, right? Which is one of the reasons why every week we follow the Baker Hughes rig count. How many new oil and gas rigs are there? Or are they withdrawing oil and gas rigs? Like I said, I can teach you. I have 30 years in the market, but the first thing I look at is volume. It shows me institutional interest and the absence of institutional interest. Then I look at the chart, because prices is marketing. High prices attract sellers. Low prices are supposed to attract buyers, right? But that's not the fair value. The fair value is where you have the highest volume at price. That in that moment in time is the fair value that the market finds based on the auction process. Buyers and sellers meeting in the market. And to say a market is rising because there's more buyers than sellers is nonsense when you think about it. It doesn't make any sense. It's illogical. Because for every buyer, there's one seller. So it's not true that one group is more or one group is less. That's not the case. What they try to say, and they fuck it up all the time, is the more important client in the market is buying. That causes prices to rise. Because the more important client is leading the pack, the dumber clients. And the dumbest client is the dumb money, is us, is retail. I'm saying this so people don't say, oh, the guy's so arrogant, he calls me dumb. We are the uninformed money here. It goes back to what you just said. Citadel has rocket scientists working for them. Rocket scientists. Fabio, your former clients, right? These guys have two heads. They're so intelligent. What the fuck am I doing? I was just a bond market maker. I'm trying to joke. I mean, I wouldn't have worked at Lehman Brothers, yeah, which is like Goldman. You have to have the top education from one of the best universities in the world. You have to be top of your class. And then you have to prove yourself in that shark tank that you can make money every week. And it's never about how much money you make. The first thing is don't lose money. It's also different from the retail trader. It's always about your max drawdown. It's never about how much money you made. Nobody cares about that. Everybody cares about, hey, Patrick, in the last 3 years, what was your maximum drawdown? Because then we have an understanding of you could cost us. You want to say something? I'm going to shut up. Yeah. Tell me. Otherwise, okay, I continue. So the risk on risk off is always about, I look at the volatility, I look at what the equities are doing, I look at what the bonds are doing, I look what oil is doing because oil is driving the bonds, I look at what the dollar index is doing. Here, there's no way I can buy gold if the dollar goes through the roof, right? I need to wait for the dollar to be rejected. I look at dollar yen as an indication of risk on or risk off in gold and commodities. So this is up all the time. All the time. Last time we talked about, okay, you're a NASDAQ trader, right? Okay, if you're a NASDAQ trader, you also need to look at other indices. You need to look at the S&P 500, you need to look at the Russell, you need to look at the Dow, right? And the transportation index to see if you have confirmation or if the NASDAQ is doing its own thing because there was news out on NVIDIA that is particularly important only for NVIDIA. Then you lose, then you're missing breadth. Breadth means how many of the members of that index are participating in the rally, or is it just based on 1 or 2 members who are very large members of that capital weighted, market cap weighted index, right? So again, it goes back to understanding a lot of things. But this is why this is called risk on, risk off. This is the answer to your question. I understand this because I put this together for myself and I'm a bond trader. So I come from this world and I'm looking at ultra long bonds here because they are an indication based on supply and demand of inflation. That's why inflation, the oil market is right next to it, right? And below it, the index. And then here's the dollar because this dollar is driving the commodity index, right? And then the dollar yen just shows me the 2 central banks, which at the moment have the largest discrepancy in terms of yield being the price for money. Money costs 0.5% in Japan. On Thursday, money will cost nothing in Switzerland. So I could put dollar Swissy on here. Why did I not do that? I put dollar yen because the Japanese economy is a lot larger than the Swiss economy. So you see, even after 1.5 hours of talking and talking and talking, you already, in me just sharing shit with you, you see how everything is interconnected and how there's always logic. Whatever I do, there's always a logical reason why it's there. Everything has a reason. Nothing I do is a waste of time or doesn't have a reason why it's on the chart. Everything I do is, I completely understand what the fuck is going on in the world. Completely. And it's my job to make money. And I'm telling you, I have been doing this for 30 years and even I get fucked. That's a fact. It happens. I was completely naive on April 2nd. I was very long risk. And then Trump comes up with this Liberation Day bullshit. And I didn't have the experience after 30 years, and I didn't have the imagination that a president of the United States of America would fuck the world up and throw us back 80 years and reintroduce tariffs. Yes, he talked about it through this entire campaign, but I heard it, but I didn't hear it. And this is something what I often teach my own traders. I say, I know that you're hearing my words right now, but since you haven't experienced it yet, you don't hear me. There's a difference between hearing and hearing. You know what I'm trying to say, right? So now I know that this guy is fucking sane, and now I trade very, very differently. Very differently. I don't trust any second because Apple will come out with a new headline and a new tweet, and then I have to be. I'm much shorter now, right? Right now I'm much shorter in trading, or I'm very hands-off in investing. because Trump creates great investments. He makes life interesting, somewhat difficult for trading. Interesting, you know, it can have great opportunities, but it's a difficult, different environment we live in right now. Again, a VIX at 20.75 is a completely different world than we had last year when the VIX was at 12, for example, right? It's a lot easier to make plays when the market behaves. A VIX at 21 is a market that's like your ex-wife being drunk and throwing nasty words at you because she thinks you misbehaved, which you didn't, right? It's hysteric. The market is hysteric right now. Fabio.
Jay, but I think we're going to get cut out very soon. So I don't know if, Patrick, you have anything to add, but
yeah, so I have to add about something about this, of course, always. So I think I was reading something really interesting, and as Jay was saying, you have to be really careful with the news. You have to be proof this, and we were speaking about the rates. So Jay was saying, okay, we get now rates on 0 on Switzerland, and we have the Japanese on 0. And he was talking about the importance of the FOMC. So guys, please be careful, because what was happened the last time when we get the Japanese carry trade, everyone knows it. If this will be messed up, so you have to be really careful. This is something where you can connect your experience. And I think only it was last year, the Japanese carry trade, where we get really strange the downside. And this is something where you was experienced, but maybe you was never understanding the background. Why was this happen? And now it's the best time to educate yourself, all listeners, to understand what was happened on the Japanese carry trade, because it could be really possible that we're getting some next idea what would be happen in the future.
Yeah, very good point. Very good point. Right. And happy to do a topic next time. I mean, if you get questions, you know, we can see what is the most important question to your clients, and then we go ahead and do 1 hour on just, you know, and I'll teach you something about, for example, the carry trade as an example.
So for everyone, guys, send us an email if you want to get in contact with Jay, if you have questions about the session. I think this was an amazing masterclass for 90 minutes on really Forex, market structure, Gamma, and why is this important. So I really thank you, Jay and Patrick, for being here, and look forward to having you in the next session.
Thank you very much.
Thank you very much. Thank you also. Thank you. And then also, I can only add to this, if you want more, I cannot stress it enough. This was a masterclass, 90 minutes. But think about how you could rise as a trader if you be 1 year on the side on Jay. So we talking on MentorQ always, you need an edge, and MentorQ will give you the second confirmation how you can place your trades about your edge. And Jay is someone who can build and help you to develop an edge. So take the opportunity really seriously, and send a message to info@mentorq.com with any questions you have. We will send this to Jay. You will get the answer. Jay, did we get the promise that you will answer?
Absolutely. Absolutely.
So here you get the promise. So don't be shy. Send us a message. We will forward this, and you can stay in contact with Jay. This is a one-time opportunity for you guys.
Great. Awesome. Thank you very much. I'll see you soon, Fabio. Thanks for setting this up. It's a pleasure to work with you as always. And greetings to all you traders. Trade smart, live free, as we say in our company. And I'm looking forward to seeing you soon. Goodbye.
Thank you, guys.
Thank you. Ciao.